Inflation and Interest Rates by www.profitabletradingtips.com. Manufacturing output and consumer prices are up this month, which according to Reuters is an indication of inflation turning the corner. Next, we will probably see the U.S. Federal Reserve at long last raise interest rates. U.S. consumer prices increased in October after 2 straight months of declines as the cost of health care and other services rose. Evidence of firming inflation that further supports views that the Federal Reserve will raise interest rates next month. The economic outlook also got a boost from the other data on Tuesday, showing a fairly solid increase in manufacturing output in October after dropping for 2 consecutive months. Unemployment is at 5%, which is putting upward pressure on wages. There are 3 factors pointing to inflation, and interest rates are likely to rise. U.S. Federal Reserve. Forbes also notes that there is a re-emergence of inflation, and interest rates are likely to rise next month. Even before the latest inflation figures, the U.S. numbers for October, the general consensus was that the Federal Reserve is going to start raising interest rates at their December meeting in the 15th and 16th of that month. Now that we've seen those inflation numbers, barring any further surprises, then we're close to a stone-cold certainty that rates will indeed start rising next month. It's worth walking back a bit to see what the basic economic problem here is. The Fed wants to keep inflation below 2% and unemployment in the 4% to 5% range. The problem is that when the Fed raises rates, it typically takes 1.5 to 2 years for higher rates to work their way through the economy and reduce inflation. That is why the Fed has been anxious to raise rates after keeping them a near zero since the depths of the Great Recession. What does all of this have to do with stock trading? Stocks, inflation, and interest rates. Many stock traders simply buy and sell the S&P 500, which is a good measure of the U.S. economy. To the extent that the Fed manages inflation and interest rates correctly, the economy will prosper and stocks will go up. When they mess up, stocks eventually suffer. The Street writes about the S&P 500 and a potential crash from a technical viewpoint. As noted last week, 2020 is an important level of support for the S&P 500. It must be held to keep the bullish counts alive. Sunday night, as most of the market seemed to be looking for a crash, the trading room at ElliottWaveTrader.net was setting targets for an expected rally Monday. The market hit those targets. But the question now is if the market can maintain this uptrend or not. If the market declines steeply Tuesday and provides an impulsive pattern to below 2020 and into the 1990 region, that would provide a strong warning of a much bigger decline to come in December. Even in that case, there will likely be a wave 2 retrace leading into Thanksgiving and back up towards the 2100 region. Whether the S&P 500 maintains or falls in the short term, it will respond to a healthy economy over time, providing that the Fed does a decent job handling inflation and interest rates. For more insights and useful information about trading stocks, options, futures, and Forex, visit www.profitabletradingtips.com.